Welcome to this week's series of Credent Connect. And today we're going to do a little bit of a slight market recap, slight overview of the macro backdrop. Going to touch on oil markets a little bit, and really want to hone in on the stock market as well, kind of how things have transpired, because there's been some really interesting shifts over the past couple of weeks here, especially following the Iran conflict that's commenced here at the end of February through about mid-March. Of course, I'm joined by Alicia Norris, who's Senior Portfolio Manager, and have some charts for you guys again today, which I think, we got some good feedback in this process. We'd love to share charts. We're swimming in data at any given point in time. And obviously what's been the forefront for us, rather, has been just the oil market in general, right? Oil prices have skyrocketed. And the reason for that is obviously self-explanatory why oil prices have skyrocketed. What we want to provide is that context here of these oil prices. And what you're seeing on your screen here is Brent crude oil prices, the actual commodity itself. And with that spike close to $100, right? We actually surpassed $100 at one point in time. But this 5-year snapshot, I think, provides some interesting backdrop of understanding where we came from in oil prices. If you recall, in 2022, there were the inflationary pressures that we saw in 2022, where oil actually hit about $120 a barrel before coming right back down to earth. And where we're at now, and I'll show you a percentage change here in oil, roughly 69% increase in the price of oil. Geopolitical driven, right? Very exuberant price increase. Such a massive pop is never doesn't actually live at those levels for long. It can stay higher, but doesn't live at those levels for long. But Alicia, what's interesting about this, and kind of what I'm going to ask you to kind of maybe expand on for us and for clients, prospects, whoever's watching this oil spike has reintroduced the narrative of inflationary pressures at a similar undertone as that, back in 2022, 2023, when we saw the consumer price index kind of spike. And of course, right, crystal ball doesn't exist. What does exist, however, is general data that points us and tells us what may actually transpire. With that, walk us through a little bit through the five-year forwards. Nope, I didn't repeat myself there. It is called 5 years. Walk us through what this is, what we're paying attention to, and what this may transpire down the road here.
Yeah, so the 5-year forward is the market's estimate of the average inflation rate expected for the 5-year period that begins 5 years from now. So the reason why that is important, and it's the reason why Edison and I are glued into this data and watching this data, is because this figure historically has a really high correlation to how things do transpire. And the Federal Reserve cares about this because they care about inflation expectations. These inflation expectations are typically what causes volatility in the markets. So when we look at this chart, you can see periods of really volatile inflation expectations. But if we just look all the way to the right and look at the figure for March, it's sitting at 2.3 right now. So it's not much higher than the Fed's 2% target. What we're looking for is if this ends up creeping higher, we're really watching that. And the longer that the conflict persists, I think the more important this indicator becomes.
Yeah, great point. And for those of you watching this that remember back in the Volcker days, right, during the crises of the 70s and 80s and the inflationary pressures, yes, inflation was trending higher, but what was the main catalyst for added volatility across capital markets was not the present day inflation. Rather, it was the 5-year forwards, as well as the 1 and 2 year forward expected inflation rates that actually caused the volatility of the equity markets to transpire. We are paying attention to this. It is meaningful. However, right, look at the previous 5-year chart here, that this is a 5-year snapshot. Those peaks are certainly nowhere close to where we're at today. So at 2.3%, anything below that 3.5% mark is okay, right? Inflation at the end of the day is healthy. We want to have 2 to 3% inflation in that range over time. Certainly the exuberance of it here with the oil prices in the interim have caused that expectation to be misguided, right? Or that assumption to be misguided. So great stuff there. Shifting to the stock market, shift kind of broader capital markets. Alicia, maybe you can give us an overview of kind of what happened to international relative to US last year from that standpoint. Clearly, one of the Cinderella stories of 2025, driven primarily by what happened with the dollar for the most part. And then how has that actually transpired here year to date? Because we have seen quite an interesting spread of performance in the US equity market relative to international markets and relative to even the dollar.
Yeah, so when you look at it last year, what we saw was that international, whether it was developed international, so Japan, the UK, those countries versus emerging markets, so China and other emerging markets, we saw them rising around 30% last year. So
Yeah.
as the dollar was falling throughout 2025, that was a really great tailwind for international. As we came into 2026, particularly over the last, I would say, 2 to 3 weeks, since we had some of this more geopolitical risk premium baked into the market, we're starting to see that flight to quality again, where we're starting to see domestic equities actually start to outperform international markets again.
Yeah, absolutely. So the flight to safety, you've probably heard this on the news a lot, right? Flight to safety can signify a flight to US Treasuries or a flight to an asset in a capital market that actually tends to maybe gain value during volatility or lose less value in that interim. And we're seeing that this year, right? What you're seeing on your screen right now is what's called a normalized chart. And all that means is that it tracks the percentage change. And that white line right there, that's the S&P 500. This is so far from the start of the Iran conflict all the way to maybe about halfway through March. And when this figure is below 100, it signifies percentage loss. Above 100 is a gain. And right now it's sitting at about 97.46. The way to interpret that is 100 minus 97.46 is roughly 2.5%. The S&P is down 2.5%. What has been a eye opener in the interim here, as Alicia mentioned last year, international assets did exceptionally well, driven by the dollar and a few other catalysts. But international assets so far year to date are down nearly 9.5, nearing that 10% loss threshold. So as the conflict arose, that flight to safety didn't necessarily go to treasuries, but it did go to U.S. equity assets. That's actually a very positive notion of kind of what's happening. And Alicia, walk us through the this DXY currency right here. Kind of what's happening with the dollar as a result of this flight to safety notion year to date, which has been quite tremendous.
Yeah, so as we were seeing the dollar fall last year during this flight to quality, we're starting to see the dollar rise. That is turning to a headwind for international markets. And this is just really showing that money is coming back into the US. We're seeing that predominantly in the large cap space. I think you can also think about the differences between domestic equities and international. There's a lot more industrial companies in developed international markets, right, where oil is an input into their production and their products. Whereas on the domestic side, we're much more, technology focused, and those sort of industries don't require that input cost for oil. So I think all of those is really a combination of why we're seeing more flight to the United States and a rise in the dollar since that geopolitical risk has increased.
Yeah, great point. Right, this could easily reverse, right? I think any mentions from the White House or the administration on any changes, any strategic changes, you could certainly reverse. But what should give a lot of reassurance to clients, to prospects, or to the whole team, I think to the U.S. economy in general, is this notion that when there is risk in the world, the U.S. is that flight to safety piece. Okay. And if you recall from our view of 2026, when we released our research here in December of 25 for this year, one of the things we were adamant about was this notion of going against the grain and being slightly contrarian on this belief that the US dollar would continue its perpetual downslide. Not the case whatsoever. Now, of course, we did not foresee a geopolitical event such as this, but nonetheless, that downside, the way things were trading, the way the smart money, aka hedge funds, institutional accounts, were putting money to work, did not fit the narrative, and we certainly did not buy into that trend. And speaking of not buying into that trend, right, one of the things that we've also been very vocal about, especially over the past couple of years and especially over the past 6 to 7 months, is this idea that the average stock is going to do better or can do better than the S&P 500. because if you recall, the S&P 500 is very top heavy in that those first 5, 6, 10 names tend to carry significantly the significant portion of risk and return attribution for the index. That's actually transpired in a way that has been quite interesting and very positive for portfolios here year to date. It commenced in about mid-October of last year in 2025 and has continued to be as such here in 2026. And what you're seeing in front of you is a little bit busy chart. Maybe Alicia, I'll have you walk us through it a little bit. It's somewhat busy. Here's what to note. We kind of segmented this down to the Magnificent Seven, right? Many of you have likely heard that term, the Magnificent Seven or the Mag Seven. And it's Apple, NVIDIA, Microsoft, Amazon, Google, Broadcom, and Meta, right? That's seven right there. They're significant because they're in the tech space. They're significant because they're spending a lot on AI. They're significant because they have all the cool Chat GPT-like features or Gemini and things of that nature. But exuberant valuations can only go this far, right? There's a headwind that comes into fruition there. Alicia, walk us a little bit on what this blue line is, kind of what that means, and kind of why we're paying attention to that so adamantly. And then maybe we can touch very briefly on kind of our expected profile of these names, because we have certainly taken a risk management backdrop to it.
Yeah, so the SPW index is the S&P 500 equal weight index. So it's the same 500 stocks that are in the S&P 500, but instead of taking that, I guess, enormous concentration in technology or discretionary, it weights every single stock in the S&P 500 on an equal weighted basis. So Apple is the same weight as something like a Walmart, for example. So all of the different colors in this chart are the Mag 7, but what's really important is the blue line at the top. That is showing that the average stock is up 1% year to date, whereas the Magnificent Seven is technically, in a technical correction as a whole, down 10% over this time frame.
Yeah. And for many of you that have followed the news on this, right, and have followed our discussions and our views on the topic, spending capital expenditures on AI type investments, alternative investments, and research, and everything associated with that craze, that bucket that is AI, those are fantastic. There comes a point where the stock market prices returns on what's going to happen over the next 6, 9, and 12 months. That's how the stock market is typically priced, whereas the bond market is priced more so kind of like what's happening right this moment. That's the biggest difference between the two. As earnings are coming out, all of these companies are posting great forward expectations, but they're not posting exuberant expectations like they used to. So when you go from posting exuberance to posting really good results, the market's like, oh, am I willing to pay that multiple? We're seeing that come into fruition, paying attention to it. We have certainly pivoted away from these names from a concentration standpoint, and we stand ready to jump back into them as opportunities arise. So at the end of the day, the AI craze is not going anywhere. We certainly want to be more risk-centric, risk-forward in that approach, rather than trying to catch a falling knife, if that were to happen in this case. So with that in mind, thanks for watching. We'll be back hopefully here in a couple of weeks with another segment like this, and we'll keep you apprised of any developments in the market.